𝐻𝐿𝐶 has arrived. 𝐻𝐿𝐶, welcome. I don't know where we were able to stop last time. I don't know if there's anybody who can be able to remember the paper where we left. I can see somebody has written something here. Okay, welcome, 𝐻𝐿𝐶. I want to know where we left last week. I'm a little bit confused on the last question we did. But in case you're not able to remember, we can look at this paper on April 2023. So this is a very interesting paper, and this question one had this particular question, and the question asks, highlight 5 benefits of using committees in decision making within an organization. So basically, a committee.
Yes, so basically in this case, a very quick recap on what you have said is that a deferred tax basically is a tax which the company was supposed to pay during the current year. That tax has been deferred, it will be paid in the future, or it is a tax refund the company was supposed to get during the current year that has been deferred. The company will be refunded that tax in the future. Now, we have therefore 2 types of deferred taxes: the deferred tax liability, deferred tax asset. So a deferred tax liability basically have said that this is a tax which is payable by the company in the future. We recognize that as an current liability in the statement of financial position. Deferred tax asset is a tax to be recovered by the company in the future. This one is recognized as a non-current asset. Now, on the other hand, we have said a deferred tax basically arises as a result of the difference between the accounting profit and the taxable profit. If these two profits are different, the accounting profit and taxable profit, that give rise to deferred tax. And basically, I've said the taxable profit is a profit which is computed by the company based on the existing tax laws. The accounting profit, this is a profit which is computed using the accounting standards and also the various accounting policies adopted by the company. Accounting policies include things like the methods of depreciation, how is the company depreciating its assets, and so on. So therefore, if these two profits are different, basically we are saying that will give rise to deferred tax. And basically what we were looking on this small illustration here, we have said that we assume the taxable profit of the company is 30 million. The accounting profit or the profit before tax is 40 million. The tax rate applicable to this company is 30%. And then what you're required to do is we compute the deferred tax. Now, we have said that for us to be able to compute the deferred tax, the first thing we need to do is to determine the tax which was supposed to be paid during the current year. The tax which was supposed to be paid by our company should be 30% of its profit. And basically, in this case, I've said, when talk about profit generally, we are referring to the accounting profit. The accounting profit in this case is how much? 40 million. So the profit, the tax which was supposed to be paid will be 30% of the profit, which is basically 40 million. That will give us 12 million. But now we then need to ask ourselves, is this the actual tax to be paid by our company? Is this the actual tax to be paid by our company? Automatically, no. Because you can see we have the taxable profit. In other terms, this taxable profit is different from this. So therefore, the actual tax to be paid by our company here will be 30% of the taxable profit. The taxable profit is what? Is 30 million. And that basically will give us what? Will give us 9 million. Now, the difference between these two figures there, the tax the company was supposed to pay, and the actual amount of tax to be paid by our company here, that is 3 million. 3 million, we refer to this as a deferred tax. We refer to that as what? As a deferred tax. Deferred tax, why? This, you can see during the current year, the year 2024, our company was supposed to pay a tax of 12 million. But the actual tax will be paid would be 9 million. Reason being, the accounting profit and taxable profit are different. It basically means that during the current year, the company has paid less tax than what it was supposed to pay. Now, this one will be known as a deferred tax liability. Will be known as a deferred tax what? Liability. Will be known as a deferred tax what? liabilities. The tax the company was supposed to pay during the current year, but because the taxable profit is less than the accounting profit, this tax has been deferred, and basically it will be paid in the future. Now, as an accountant, the moment you are preparing the income statement, what you need to do, the moment you have to prepare the income statement here, the income statement, you should always start with the profit, or actually, once you have this profit before tax, like in our case, the profit before tax is 40 million. So to this, you come and you less the current tax. The current tax is the actual tax to be paid. The actual tax to be paid, this is basically what you refer as the current tax, and that is 9 million here, 9 million. 9 million. Also, you can see during the current year, our company has paid less tax with 3 million. Now, what you need to do as an accountant, in accordance with something called the prudence concept, you need to set aside 3 million from the profit of the current year to be used in terms of paying these taxes, tax in the future. That is in accordance with the prudence concept. Remember what prudence concept requires, that if you expect a loss to be, if you expect to incur loss in the future, you need to provide for it today. You need to provide for it today. So we make a provision for 3 million. To make a provision basically means that from this profit, we will set aside 3 million to pay the tax which the company was supposed to pay during the current year, but it has been deferred. It will be paid in the future. So basically, this one we refer to it as a deferred tax expense. A deferred tax expense. So that is not necessarily the tax which has been paid, but basically what we are doing, we are creating a provision. We are creating a provision. We know what is a provision. A provision, even from your salary, is where you set money aside to do something, to undertake a project you want to do to undertake in the future, or you want to implement in the future. So therefore, this is not a tax which was necessarily paid, but the reason why we are deducting that from the profit is purely to do to create a provision, to set aside 3 million to be used in terms of paying the taxes which are expected to be paid in in the future. In the future. Now, in this case, or basically this difference between the accounting profit and taxable profit, that difference, the difference between the accounting profit and taxable profit, can actually be classified into two main categories. We have something called the permanent difference, and then number two, we have something called the timing difference. The timing difference. So what do you mean by the timing difference and the permanent difference? Which we are saying is that difference between accounting profit and taxable profit. Now, first of all, we'll talk about the permanent difference. This is actually the difference between these two profits. The difference between accounting profit and taxable profit, and what causes this difference. This difference is basically occasioned or basically caused by taking into account certain items of incomes and expenses in the computation of this profit, in the computation of accounting profit, but those items are not taken into account in the computation of taxable profit. In the computation of taxable profit. In the computation of taxable profit. So this one is caused by taking into account certain items of incomes and expenses, items of incomes and expenses, items of incomes and expenses only in the computation of the taxable taxable profit, but those items are not taken into account in the computation of taxable profit. And automatically, you know which are these items. Which are these items of incomes and expenses? These items are non-taxable incomes and disallowable expenses or non-deductible expenses. For example, what we know in computing the accounting profit, we may take into account expenses such as penalties, fines, amortization of assets. So all these are expenses, penalty, fines, and amortization. So we take into account all those particular expenses in the computation of accounting profit. But basically what we know in taxation is that those expenses are non-deductible or they are disallowable expenses. That's basically what we know. In computation of the taxable profit, you don't, or basically those items are not taken into account. We don't take into account penalties, fines, and amortization of assets, including impairment loss on goodwill. So automatically, that will give rise to a difference between, or make the accounting profit and taxable profit to be different. And that difference is known as what? The permanent difference. The permanent what? Difference. Now, we say that this difference basically does not give rise to deferred tax. And therefore, in the computation of deferred tax, this difference is what? Is ignored. This difference is what? Is ignored. So the question you may come across in relation to that in an examination setup is just whereby you're required to explain what is permanent difference. Sasa? Yes. Now, on the other hand, when we talk about the timing difference, this is the difference which is occasioned by taking into account items of incomes and expenses in the computation of two profits, the accounting profit and taxable profit, but in different accounting period. But in what? Different accounting period. Different accounting what? Period. Different accounting period. For example, in this case, you may be told that a company incurred a certain expense in the year 2024, and this expense will be taken into account or will be used in the computation of accounting profit, maybe during the year 2024. But this expense will only be treated as a allowable expense, maybe in the year 2026. So meaning that this expense will be used in the computation of the two profit, but in different accounting period. In computing the accounting profit, it will be considered in the year 2024. In computing the taxable profit, it will be considered in which year? 2026. Now, this is basically the difference which gives rise to deferred tax. Is the difference which gives rise to the deferred what? To the deferred tax. So the timing difference basically is the difference which gives rise to what? Is the difference which gives rise to the deferred what? Which gives rise to the deferred tax. Give rise to deferred tax. As Anne is asking what? Assuming practically the company has excess what? Excess refund claim from KRA. Is the deferred tax asset? Is this a deferred tax asset? Is this a deferred tax asset? It all depends. Basically, if a company has a tax refund claim, so the company is claiming a tax refund. A tax refund claim is usually an asset. Is usually what? An asset. That is the first thing. But if, for example, you expect to recover this, or maybe you automatically, does KRA refund? Yes, maybe you have the necessary documents, you can refund. But in most of the cases, you offset that maybe against the future what? Taxes. So usually we treat that as a deferred tax asset in case that amount of money is expected to be refunded beyond, for a period beyond 1 year. For a period beyond what? Beyond 1 year. But essentially, a claim for a tax refund is usually an asset. Is usually what? An asset. That's that? Yes. Now, in this case, I want us to look on some few terms. Basically, we're going to come across in the computation of deferred tax. We look on some few terms here. Definition of terms. These are also terms you may be required to define in an examination setup. Definition of terms. So the first term here is something called the carrying amount, abbreviated the CA, carrying amount. So what is CA? So this is the value of asset or liability in the statement of financial position. So that particular value at which an asset or liability is recorded in the statement of financial position, we refer to it as the carrying amount. We refer to that as what? Carrying amount. For example, we know that items of PP are recorded here at their net book value. So the value at which an asset or liability will be recorded in the statement of financial position is the carrying amount. Number two, we have the tax base. Tax base basically is the value of an asset or liability for tax purpose. For tax purpose. For tax what? Purpose. Let me give a good example of maybe an asset which qualify for investment deduction, or for an asset which qualify for what? for investment allowances. This is something you did in PFT. There are those assets which qualify for capital allowances. Now, if you happen, for example, to own such an asset which qualify for investment or capital allowances, and basically you sell that asset. You sell what? You sell that asset for you to be able to determine the amount which you're going to treat as a taxable income or the amount which you're going to treat as deductible expense. You take the sales profit minus the written down value. Minus the written down what? The written down value. There is a name, I think, which was given to this in taxation. I think trading, are they called trading receipt? Yes, something like that. So the difference between the sales profit and the written down value. So that amount is the one which is allowable or deductible in taxation. So therefore, in computing that amount which will be allowable or deductible in taxation, what do we consider as far as this asset is concerned? The written down value. So therefore, tax base is the value of an asset or liability for tax purpose. So the other term is temporary difference. Temporary difference. Now, temporary difference abbreviated as TD. This is the difference. This is the difference between these two values. The difference between carrying amount and tax base. Carrying amount and what? And tax base. So in other terms, to compute the temporary difference, we take the carrying amount minus the tax base, of which in this case, we can either get a positive figure here, or we can get a negative figure. So if we get a positive figure, that one is called taxable temporary difference. If we get a negative figure, that one is called deductible temporary difference. So therefore, in that case, we can say we have two types of temporary differences. We have the taxable temporary difference. Actually, this one is abbreviated as TTD. Just understand, remember those abbreviations. TTD, taxable temporary difference, whereas this one is called the deductible temporary difference. Deductible temporary difference. So therefore, here we have two types. Types of temporary difference are two. We have the taxable temporary difference, and number two, we have deductible temporary difference. Now, a taxable temporary difference, we say is a temporary difference which gives rise to amount which are taxable in the future. So this give rise to amount taxable in the future. Amount taxable in what? In the future. And because it gives rise to amount which are taxable in the future, we can also say that this will give rise to, or it results to, something called a deferred tax liability. So we can say this gives rise to deferred tax liability. Deferred tax liability. This gives rise to the deferred what? The deferred tax liability. Remember from our introduction here, we said deferred tax liability is a tax payable in the future. Why do we have a tax payable in the future? Because the taxable temporary difference will give rise to amount which will be taxed in the future, which are taxed in what? In the future. So therefore, the TTD, taxable temporary difference, give rise to deferred tax liability. Now, a deductible temporary difference, this give rise to amount which will be allowable in the future. So this one give rise to amount which are allowable or deductible in the future. The amount which are deductible or allowable in what? In the future. In other terms, you can say that this give rise to a deferred tax asset. This will give rise to a deferred tax what? Deferred tax asset. I will try to simplify this because I don't want to go into details. So just understand what Morimo is teaching you here. That in case we have a taxable temporary difference, that give rise to deferred tax liability. That's just what you need to know. No need of going into details as to why that will occur. The deductible temporary difference, this give rise to a deferred tax what? Asset. Sasa, and also you need to remember here, we have those two types of temporary what? Difference. We have those two types of temporary difference. Now, the other term we can maybe define here. The other term we can also define here. Number 4, that is term number 3. Number 4, we have basically what you have already mentioned here. Deferred tax liability, deferred tax liability. And from my introduction, you've already said that these are tax payable by the company in the future as a result of taxable temporary difference. Tax payable in the future, tax payable in the future as a result of taxable temporary difference. As a result of what? Taxable temporary difference. So therefore, how do we compute this one? How do we compute the deferred tax liability? This is basically one of the formula you need to remember. How do we compute the deferred tax liability? We take the taxable temporary difference. The taxable temporary difference, we basically multiply that with the tax rate. We multiply that with what? With tax rate. That formula you need to remember. That is one of the formula we're going to apply. The other term, the last term, you need to know how to define here. Deferred tax what? Assets. So deferred tax what? Asset. So deferred tax what? Asset. Now a deferred tax asset. Basically a tax